What if I told you the world's most powerful currency is quietly losing its grip and it might just take the global economy down with it? The US dollar has fallen over 10% since Jan. And no, this isn't just market fluctuation. This was triggered in part by Trump's tariffs. His idea: make American industry more competitive by pushing the dollar down. But here's the catch. Trump never actually wanted a weak dollar. What he really wanted was for other currencies to stop being unfairly cheap. Translation: he wanted to fix the trade imbalance without scaring off foreign capital. Instead, he got both the problems: falling dollar and fleeing investors. When the dollar fell, so did the confidence. Instead of flowing into the US assets, money started leaving. Investors dumped stocks, they also dumped bonds, a move that usually signals panic. Foreign investors began to treat the US like an emerging market. That's not just rare, that's historic. To calm the storm, the administration put a 90-day pause on tariffs, but the damage was already done. The deeper issue: the US has been running massive trade deficits because the world needs dollars. It's the global reserve currency. Countries like China and Japan hold trillions in US debt. That's how dollars circulate globally. Since global trade is mostly dollar denominated, this creates extra demand for the dollar. But the US sees this system as unfairly benefiting countries like China, a major exporter of American goods. But here's the scary part. If the US really succeeds in shrinking that deficit, fewer dollars will go out into the world. That means lower demand for the dollar, and the cracks in its safe haven image, they start widening. Trump has been wary of global moves like the proposed BRICS currency, especially as China, part of BRICS, is already locked in a long-term trade war with the US. This growing tension has shaken foreign investor confidence. For years, foreign capital fueled the US market outperformance. Even after a recent correction, the S&P 500 trades at a price-to-book ratio of 4.93x, well above its long-term average of 3.73x. But with the dollar's weakness turning structural, that advantage may soon fade. Investors are already moving out of US treasuries, shifting to gold, Swiss francs, and the Japanese yen. Even China's central bank might be selling off US debt quietly, a move that could signal economic retaliation. Foreign capital, the very fuel that made US markets soar over the last 15 years, is showing signs of drying up. And here's where it gets worse. The US still needs to borrow more, a lot more. It's expected to issue over $2.2 trillion in new bonds this year. But with inflation rising and rate cuts off the table, bond yields are going up. That means more debt at a higher cost in a slowing economy. So, what does this all mean for India? A weaker dollar could send global investors hunting for better returns elsewhere, and India is one of those bright spots. FPI inflows could pick up, but with stronger inflows, the rupee strengthens, which could hurt our export edge. So it's not all upside. Also, if global trade slows and tariff wars heat up again, India could feel the pain on its export front. From an Indian perspective, it's important to see how competing currencies perform. A fall in dollar will generally mean the strengthening of other currencies under ceteris paribus conditions, which works against export competitive advantage. And at the end of the day, the falling dollar isn't just a currency story, it's a red flag, a warning. It's possible that instead of improving America's comparative advantage, a weak dollar could be leading a cycle of long-term adjustment of foreigners selling US assets. The so-called medicine for America's trade problem may have triggered a new, more dangerous cycle, one where the dollar weakens structurally, foreign investors back away, and the world quietly prepares for life after US dominance. Is this the end of US exceptionalism? Only time will tell. But the shift has already begun. Well, that's all for today. Keep watching ET for more.